Welcome to View from the Markets. I'm Aline Van Dyne, the US Markets Editor at the Financial Times in New York. And today I'm joined by Dr. Henry Kaufman, who as an economist at Salomon in the 70s and 80s became a legend on Wall Street and remains a highly influential figure in the financial markets. Welcome, Dr. Kaufman.
Well, thank you very much.
We are now in the midst of a financial crisis that we haven't seen one as severe as this in the post-war period. Predictions from the IMF recently were that losses could almost reach $1 trillion. How did we get into this situation?
Well, I think one thing that you have to recognize is that this particular crisis is quite different from earlier ones. For example, this crisis is domiciled particularly in money center institutions in the United States, in the United Kingdom, to some extent on the mainland in Europe, while heretofore a number of crises started in developing countries because they became big debtors. That really isn't so much the case. Secondly, of course, we are now dealing with presumably what is called tradable credit instruments, instruments that are marketable. While years ago, when we had a crisis, it had to do with non-marketable instruments. The mortgage years ago was non-marketable. Today, it is a tradable. That has resulted in moving this crisis into a more of a contagion, and it went beyond the shores of the United States and rippled through other money market centers. That was not the case. We also have, surprisingly, more opaqueness in this financial market. We don't know the magnitude of the problem. The IMF, as you indicated, says it may be $1 trillion. Could be more, for all we know. We don't know where all of these weaker assets are domiciled, and there's no one who has a record of the magnitude. And then I would also have to add that this time around there have been much greater lapses in official supervision and regulation than in earlier periods.
Right. So who do you think should bear the responsibility for this? Is Alan Greenspan and the policies that the Fed pursued when he was chairman, is he partly to blame?
Well, the responsibilities have to be have to be shared by a number of key participants. You indicate the Federal Reserve. Certainly the Federal Reserve should shoulder a substantial part of this responsibility because it provided a huge volume of reserves. It allowed the expansion of credit in huge magnitudes. It provided the liquidity to really spawn an entrepreneurial attitude within the financial markets. But
this is over the last 10 years or so?
Over the last 15 years or so. But there are others who have responsibilities. The rating agencies certainly have a responsibility. Then in addition, the management of financial institutions certainly bears a responsibility. So there's a cascading series of responsibilities here. All of those responsibilities have lapsed. But the dominant, I think, responsibility has been also to be shared by the Federal Reserve, because the Federal Reserve, besides its monetary policy approach, really indicated very clearly that it was performing its role as a supervisor actually in a minute fashion, not in an encompassing fashion. There are many instances of that. Monetary policy had a high priority, supervision and regulation within the Fed had a smaller priority.
Do you think a systemic failure of the financial system has been averted by the Fed's intervention on Bear Stearns, or is that still a possibility?
The Federal Reserve has opened its borrowing facility so that the markets and the investment banks, in addition to the commercial banks, can come in and borrow by using investment-grade collateral, whatever that definition is,
right,
on longer maturities. I think that was a correct approach. But there was a failure in monetary policy to recognize this problem early on. And there were indications early on, more than a year ago, that the situation in the credit market was deteriorating. There was rapid growth of debt, rapid growth of credit. The interest rate differentials between high grade and low grade rated obligations was very narrow. The volume of financing of low quality obligations was exceedingly high in the financial markets. And if you looked around the financial community, whether it was here or in Europe, every financial community, every financial institution had very aggressive expansion plans.
Right.
Those are all the ingredients that contribute to credit excesses.
So what could have been done to curb things then to prevent what we're seeing now?
Well, this really goes back. The monetary policy that had been pursued was probably too easy, the conventional monetary policy. The Federal Reserve and its members never utilized moral suasion, and the central bankers in the past have used the pulpit to express concerns.